Today, we are talking about how the stock market has climbed 20% in the last 2 months, coming from extreme pessimism territory, all to do with Trump and his tariffs. And now we have reached overbought territory in the market, approaching all-time highs, and we're really starting to create a really dangerous situation. And therefore, I think it's a good time for us to review some fundamental jobs data, economic health of America, but that also applies for the rest of the world. And then finally, we're going to talk about stock market valuations, the S&P 500. Is this a good time to buy versus, historical evidence? However, before we get to that evidence, I just want to go through 2 recent life updates for me and for the channel. It's sort of all tied into one really. But the first one is clearly this is different to what you usually see behind me. You even see a bit of a sort of construction lamp there. And this also creates a second, update or whatever, that this is a good time to just make it really clear what this channel is going to be and what it's going to be about. So just be confident that moving forward, about 2 videos a week, we're going to be looking at, yes, the bond market, interest rates, and also just how big news events could impact your portfolio and your stocks in general, not really going into just one single name. A bunch of that individual analysis is still available in a way. It's just behind a paywall instead. So one way to make the channel more viable is there is the most expensive YouTube membership option, and that's just going to get access to a Discord group chat full of those premium members. And that's where I'll give all of the information I have about some single company names that are going through a tough time period right now, but create really good buying opportunities. That's really what I do in my own personal investing, strategy there. And the last thing to do with the channel and this update is about the style of the videos. So I've gone through periods of doing some more editing on the channel and then more casual, just conversations like this. So just be confident again that this is going to be the style moving forward. Much less editing and fancy music and transitions, all that stuff, thrown it all out the window. Who gives a shit? We're just here to get some information, have a bit of a chat and hang out, and talk about the stock market. But let's get on with the evidence pointing towards an overbought stock market. And the first big story or pieces of news is about the jobs market. The first headline here comes from the ADP, which is really the private company which processes, I believe it's like 60% or 40%, something like that, of all of the paychecks in America. So they have a great access to all of this information about employment and wages. So it's one of the best places you can find that information, whereas the government surveys that most people talk about, they are just spot checks, just people ringing up businesses from the government, and they, would have less than 1% of the total workforce surveyed. And they just came in for the month of May saying that we've had 37,000 jobs be created in the American economy on net, which is a pretty disappointing number. During a very healthy economy, you might want 100,000, 140,000, something like that, jobs created every single month. Next up here, we just have some different industries, and that is giving us where the jobs are lost and gained. So first up, we have mining, natural resources, down 5,000, which is actually a pretty big number because it's a small industry for the total of America. Construction up 6,000, that's pretty impressive. Manufacturing down 3,000, so that's going against what old Trump's trying to get done. We also have services where things are starting to get a bit more interesting. So we see IT up 8,000 jobs and finances up 20,000, but I think the financial services is more of a rebound number. That's why that's quite strong, because that's been sort of lacking, in the last 6 months. And finishing up, we get some of the biggest numbers. We have professional and business services down 17,000 jobs, and education and health services down 13,000. So that's quite interesting, where business and professional services, usually that starts to go down when the general, corporation health in America is starting to decline, where everyone, out of a workforce of, let's say, 100%, they might let go of 5%, 10% of their workforce, just trying to trim the fat around the corporation, just because business is starting to not look very healthy moving forward. If you're having slower revenue growth, still growing, but not quite as strong as the last few few years, that's when you see a bunch of these sort of initial job cuts in the economy. And that's where we've seen unemployment rate slightly tick up from 3.5%. Now we're at 4.2%, and that will slowly keep on ticking up higher as you have those, I guess whatever you want to call them, fat jobs get cut. But we have here the one industry that is carrying the entirety of the American economy, apparently, is leisure and hospitality. So even if people don't have any money left, they're going out and spending on their credit cards, going out on holidays, having a good time, going to the local pub, going to get a drink, going out for dinner. That is single-handedly keeping up the entire jobs market. Most of that story is pretty weak, but it actually gets much worse if we break it down by which size businesses are gaining and losing employment. So if we look at this here, we see mid-sized businesses, so 50 to 249 employees. That's the only area of the economy that gained jobs. They gained 51,000. And I see that type of business being your mid-sized business where it only has maybe one store, two stores in one city. Maybe it's construction, you have a team of contractors, but you don't have a multi-city business. Now, those are still going quite strong apparently, but every other area of the economy, mum and pop shops, all the way through to your mega cap Facebook and Googles and Amazons, they've all slightly lost employees. Moving on to the second half of the video, I'm just going to put into context, all of that fundamental analysis that we do, looking at the economy and jobs and all that stuff. It's that classic adage of the stock market has no connection to the real economy, but I would say it does, but it's like a, elastic band. If the stock market goes too far high above the fundamentals of the economy, then that just makes it really risky for a 10, 20% decline in stock prices. Whereas if we go too cheap, we get too fearful, the stock market sells off 25% in a single month, kind of like it did back in April, then you get these pulls upward in stock price. And that's pretty much how I measure risk out in the market and do my risk analysis. If we're getting into these overbought territories currently like we are seeing today, again, like I said before, there's a lot more risk right now in the market. And one of the best ways of measuring kind of that feeling out in the market, very, very easy to measure, and it's actually through the price targets that are published by the big banks. We can use the trend of these big banks and their price targets to directly measure sentiment. And I'm just going to go back to April and kind of name and shame a lot of big banks here. From the article about these big banks and their forecasts, we get here a few really interesting quotes that more than half of Wall Street's major big bank forecasters slash their outlook for the S&P 500 in terms of their pricing. Now that was taken from, I believe, the 12th of April. So within 10 days of the big tariff crash, half of the big banks came out and said, sell your stocks, things are not looking good this year. At the start of the year, we're expecting around a 10% gain. By the end of April, we're expecting around a single-digit decline in the S&P 500 due to those poor forecasts coming in. And if you followed the big banks' advice, you would have sold, half of your investments, moved a bunch of your money to cash. You even had people on CNN, CNBC saying you should have 95% of your money sitting in cash. Well, I'm just going to show us some screenshots of big tech companies and growth companies that did really well since that April bottom. So even Meta stock, Facebook stock, it's not really a risky company anymore, unless we go into recession. But Facebook's up 43% in about 2 months. And then we also have here Palantir stock. This one's a bit more of an ultra growth, bit more risky company, but they are up 78%. And you got rewarded for holding those risky investments during peak fear. And lo and behold, now that we've made a bunch of those gains, to get another 43% on Meta would actually be really difficult from here. Valuations are starting to get a little bit more difficult to justify. Now Wall Street is telling us to go out and buy those stocks. And when you start to see these big banks raise their price forecast, it's almost, worth doing the exact opposite, or just trying to take a bit more risk out of your portfolio and be a little bit more safe. But at the end of the day, the only thing I like to look at from all of Wall Street is what they expect in terms of the earnings outcome for the S&P 500 for the entire year. So we have here the forecast for the next 6 months is basically flat earnings. We are not really expecting great things, which is actually a slightly positive thing. It's easier to beat those expectations, but all of a sudden they expect around a 13-15% growth in earnings in 2026. Now, I believe that number is almost impossible to achieve, and therefore, when we start to look at the valuation picture, taking into account everything we've talked about in this video, we see here that the forward P ratio, now the way that Yardeni research quotes this number, it's an operating 1 year forward P ratio. So they don't take into account tax, they don't take into account debt interest payments or anything like that. And so, they're being too nice to themselves. So we've got a 21.5. And also, if we take into account the lower earnings growth that's going to happen towards the end of this year compared to what analysts expect, then we're really looking at a 22.5 easy forward P ratio. We are already at the top 1% of all valuations in the history of the stock market. And would you say we are in the top 1% of economic time periods right now? I would say that we're not. Maybe in the top third, you could argue, in terms of artificial intelligence. We've got some pretty exciting companies right now, but really outside of big tech, things are not looking that great. So overall, for the broad market, investing in the S&P 500 and just throwing your money at like 30, 40 different companies, I just think that's just not really the time to be doing that. I want to thank my YouTube members and just for those that have stuck around all the way to the end and listened to the life updates. You guys are the greatest.